Thus far, we have addressed the market comparables approach to valuation as well as the cash flow adjusted approach to valuation. The final category of approaches to valuation is what I'm going to refer to as the discount factor adjusted approach. One common application is discounted cash flow method, if you might know it by that name. To motivate this particular approach, consider how you would value a common stock. Basically, the orthodox method applied is forecasting future expected cash flows and discounting them at a risk-adjusted discount rate. This concept was introduced by a guy named John Burr Williams. He argued in 1938 that the value of a stock is the present worth of all dividends to be paid upon it. Excuse me. And unfortunately, he went on to also say that neither marketability nor stability should be permitted to enter into the meaning of the term investment value. We now know that marketability and stability or volatility does in fact have a significant impact, and we'll be exploring different insights related to that in the future. So the discount factor adjusted approach is simply taking the present value by a risk adjusted discount rate. The valuation model is simply the sum over all the future points in time where there are cash flows. We compute the expected cash flow at each of those points in time. This expectation is subjective. It's based on the entity that is doing the appraisal. And the discount rate is also subjective. And so the question becomes, what's the right discount rate and whose expectations should we be using? And so one thing we see in contrast to the cash flow adjusted approach is there are two subjective components. One is the subjective estimate of the discount rate, and the other is the subjective estimate of the various expectations. One way to express this very simply in sort of cryptic terms is the value of a financial instrument. It's simply the present value taken over some risk-adjusted discount rate of the sum of the expected future cash flows. Mathematically, if we have both state space and calendar time or maturity time, we have some risk-free rate at some point in time. We have a risk premium that is both a function of the stock that we're evaluating, the point in time that the cash flow occurs, and the particular state that occurs in that cash flow, and the particular state that occurs representing that cash flow. And then we have our subjective probability belief that that particular state will occur. And so the key insight at this point is simply that there are two subjective things to estimate. One is the appropriate probabilities, which is the same as saying the appropriate expectation, and also the appropriate risk premium or the appropriate risk-adjusted discount rate. And so the DFAA's key assumptions: there may not exist a stochastic process or processes that accurately depict the future outcomes. That is, the state space is well defined. We don't necessarily have to have that, so long as we're able to in some way come up with expectations and a risk-adjusted discount rate. There may not exist a trading strategy that produces future cash flows in each state identical to the security being valued. This was a requirement of the cash flow adjusted approach, and trading costs and other market frictions may be significant, and we can still apply this method. And so the justification for using this particular approach is we don't have to make an assumption regarding the well-defined state space. There's no appeal to arbitrage, and there's sort of this intuitive appeal to a risk-adjusted discount rate as well as our own subjective expectations. What should be clear is that this particular method, you can get a wide array of different possible valuations. If I gave an assignment to a class of 40 students, asked them to go out and value some currently traded, publicly traded stock, assuming the students did not collaborate, they'll come up with 40 different answers, and some of the answers will be significantly different from each other. And so this method does not give a very accurate valuation, but sometimes it's the best that we have, and it's all that we have to go by. Just to motivate this and get you thinking about how you can apply these types of categories of approaches to valuation, suppose we did the very unorthodox thing and tried to apply this method to a option, specifically a futures option on a call. And so suppose we have some a risk premium that we wanted to apply to my own subjective expectation of outcomes. This is a one-period binomial with the same terms that we applied in the cash flow adjusted approach. And so, but the probabilities now are based on my own subjective belief. That is, the 43% for up, 57% for down is based on my subjective expectation of the up state and the down state. It turns out this risk premium can be solved for. This is if I know all the parameters except for the risk premium, I can solve for the implied risk premium. In this case, it would be 7.5%. If I applied this implied risk premium, I'm going to get the same call price that I got into the cash flow adjusted approach. Now, this turns out to be an amazing insight if you contemplate that by using different categories of approaches to valuation, we can tease out different types of information from these models. So if I rely on the cash flow adjusted approach to valuation to come up with the appropriate fair value for a call option, if I further develop my own subjective estimates of the future distribution of outcomes, then I can actually solve for an implied risk premium that is appropriate for this particular investment in this call option. And so this is just, again, giving you an insight into why having multiple approaches to valuation is important and how they can, this is just one example of a simple application across different approaches to valuation. The main insight from the DFAA approach is transaction cost assumption is not critical. We can actually apply this to a private company, a non-public company. Requires assumptions regarding future behavior of the underlying instrument by the investor. That is, they have to come up with their own probability distribution beliefs. Also, there has to be some sort of assumption on the risk aversion nature of the investor in order to come up with the appropriate risk premium or risk-adjusted discount rate. And intermediate trading is not required. Recall that with the cash flow adjusted approach, this intermediate trading was required. Strong beliefs on the direction of underlying may influence the spot price as well as derivative prices, assuming arbitrage is not possible. And so the linkages remain, but the DFAA approach is primarily applied to underlying instruments like stocks and bonds. So in summary, there's no static or dynamic replication required. Subjective information possible. Investors' risk aversion is often implied. We don't make any assumptions regarding intermediate trading. And strong beliefs directly influence valuation and other risk measures. So just to line up these three different categories of approaches, and then examine some of the fundamental assumptions that are applied. And so the short selling allowed with full use of proceeds is a very strong assumption for both the market comparables approach and the cash flow adjusted approach, but it's really not relevant for the discount factor adjusted approach. Trading costs are minimal. That's a somewhat weak assumption for the market comparables approach. It's a very strong assumption for the cash flow adjusted approach, and it's not really relevant for the discount factor adjusted approach. Thus, if trading costs are severe, then it's not surprising that the cash flow adjusted approach might not work very well. A set of securities exists to replicate payoffs. It's a very strong assumption for the market comparables approach, but it's not really that relevant for the cash flow adjusted approach or the discount factor adjusted approach. Assuming some stochastic process to model the risk variable, it's not relevant for market comparables because that's just a set of trades you put on today to perfectly replicate future payoffs. It doesn't matter what the stochastic process is. It's a very strong assumption with the cash flow adjusted approach. And there is some weak tie-ins to the stochastic process in the sense that the investor has to make probabilistic statements. Those probabilistic statements are typically based on some sort of at least implied stochastic process. The trading strategy exists to replicate the payoffs. The market comparable approach does not require a trading strategy, neither does the discount factor adjusted approach, but the cash flow adjusted approach does. Explicit risk adjustment is only applied in the discount factor adjusted approach. It's not relevant for market comparables or the cash flow adjusted approach. So one important thing in your future as a quantitative financial analyst is you will be asked to opine or appraise the fair value of a particular instrument. The ranking, the most accurate way to come up with a fair value is to use the market comparables approach, if at all possible. Unfortunately, it's not possible in many different contexts. The cash flow adjusted approach is second. If I can do the self-financing dynamic replicating required, then I can apply this method and I don't have to make assumptions about risk premiums and I don't have to rely on subjective expectations. The worst method of valuation, although we use it frequently, is the discount factor adjusted approach. It requires future distribution assumptions to come up with the expectation calculation, as well as risk premiums. It's often used when market comparables and cash flow adjusted approach are not possible. So in summary, there are three categories of approaches to valuation. You can think of market comparables as simply the sum of a set of other instruments. The cash flow adjusted approach sort of lies in between the discount factor adjusted approach and market comparables, in the sense that I do take the present value of future expected cash flows like the discount factor adjusted approach, but I can use the risk-free rate and the objective equivalent martingale measure, risk-neutral probability measure in order to come up with my valuation. The final method requires two subjective estimates. One is how do I calculate this expectation, and the second is how do I come up with the risk-adjusted discount rate. This is a widely used method for many financial instruments, but it's important to understand the level of epistemic uncertainty that we have is very high with the discount factor adjusted approach. And that's why often in things like litigation, you have two sides that argue that some instrument is worth radically different prices. Both of the different sides are basing it on a set of assumptions about expectations and discount rates. And so that concludes the reviewing the text material. We turn next in the next video to exploring some selected modules related to these three categories of valuation.